Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a 1-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And as you can see, I have some lines on there that basically represent the forecast that I made from last week. What I do each and every week is I leave those lines so that we can compare what the market has done relative to what was forecasted the prior week. And you can see how accurate these reports are each and every week. It's almost uncanny how well the markets are reacting to the technical signals. And if you take some time to learn how to read these technical signals, obviously you're going to put the odds in your favor, and there's a higher probability that you're going to make money. Now, the key in using technical analysis as a tool is to use it more as a risk management tool than a crystal ball. Yes, my percentage of accuracy is very high, but as you'll see, if I can identify a support level, let's say here, and the stock breaks down below that support, I know I need to do something with my position, either sell some of it or put some protective stops in place, or maybe look for bear funds of some sort to hedge my position. But I know I just can't sit there and watch the market drop. So my forecast last week was that we would bounce off of the support level. We did just that. And I'm going to leave this line in place because we are starting to move up. Even though we closed down this Friday, I do believe that next week we'll start to move back up to retest this former trend line and possibly fill that gap. There's some other indications that tell me why that's a higher probability than us collapsing next week, but we'll look at the VIX in a little bit and I'll show you what that's all about. The Russell 2000, that's ticker symbol RUT. This is a more broad-based index, and you can see that I left my lines again from last week. I said that we would come down and bounce. We're in that phase of pivot point right here, so I'm going to leave this line for next week. I believe that we could rally just a little bit before we hit this down leg, or that trend line that represents the down leg, and then we can pull back from there. Once we start breaking down below these support levels and staying below, that's when things get really interesting, because it tells us the sellers are moving in with full force. So again, I'm going to leave these lines for next week so you can compare those as well. Looking at the spiders, that's ticker symbol SPY. That's the S&P 500 ETF. You'll see again, my lines are in place. I said that we would bounce, and we did, right off of that support level. I do believe that we're going to continue higher, fill this little bit of a resistance area right here, pull back from resistance, and then I believe long term we're going to go a lot lower. Looking at the Qs, this is the Nasdaq market represented in the power shares, QQQ. Again, my lines are in place. We followed this bounce almost perfectly. Let me zoom in so you can see how accurate this was. I said we would pull back, bounce off of this support level. We did that within pennies, and then it followed that line right up there. Remember, when I drew that line last week, there was no price action. That's how accurate these charts are. And you might say, well, how did you know it was going to go up that way? Well, I simply look at history. I go back, I look at former up legs, I measure those, and then I draw my angles very similar to what we had in the past. You can see here that the angle from that low to that high is very similar to the angle that I drew last week. From that low to that high. Again, very, very similar angles, and that's how the markets are moving. We have higher volatility here, so the angles at which the market moves are going to be more severe than if we're in a calmer, less volatile market. So keep an eye on these indicators and make sure that you're using protective stops to protect your position. Now finally, looking at the VIX, this is the volatility index. If you don't have this on your watch list, then you're missing out on a very big leading indicator. The VIX, the volatility index, is a contrarian indicator to the S&P. So in other words, if the VIX looks bearish, and I think we could still go down to fill this gap down here, if the VIX goes down to fill that gap and price drops, that means the S&P will most likely rally. I think we're going to continue to come down, fill that gap. What I'm going to do is I'm going to remove that line, and I'm going to remove this line, and I'll draw a new line representing that same angle where I think we'll pull back from here, we'll fill that gap, and then we'll start to bounce. When you see the volatility index starting to move up after this gap is filled, watch out below in the S&P. In fact, you can watch out below in the rest of the indices as well, because if the S&P is dropping and the Russell 2000 is dropping, chances are we're going to have a domino effect, and the rest of the markets can turn into a bear market very easily. If you'd like to learn more about what I've just mentioned regarding gaps and trend lines and how to draw support and resistance, just go to themarketguys.com and click on the video tab right there. And there's a whole library of free videos. We call these market shots. This is your daily financial vitamin that you could pull up each and every day and learn more about technical analysis pretty effortlessly. You don't have to spend a whole lot of time because each one of these videos are anywhere from 3 to 5 minutes long. It does not take a whole lot of time, and you can watch them over and over again. So for now, this is AJ Monty, Chief Market Strategist with The Market Guys. Have a great day, and we'll talk to you soon.